What's going on, guys? Before we get into this is educational content, not investment advice. I'm not your financial advisor. Options are serious tools and they can clean you out if you don't know what you're doing. So let's learn something today. Today we're talking about the number one way new options traders lose money during earnings season. It's called implied volatility crush. And if you've ever bought a call right before earnings, watched the stock go your direction, and still lost money, this is why. Okay, so first, what is implied volatility? I'm going to keep this simple. Implied volatility, or FOR, is just the market's expectation of how much a stock is going to move. That's it. It's a number that tells you how much uncertainty is priced into the options. Before earnings, nobody knows what the numbers are going to look like. Could be great. Could be terrible. Could be somewhere in the middle. And because of that uncertainty, for spikes, options get more expensive. You're literally paying a premium for uncertainty. Think of it like insurance before a hurricane. When the storm is coming, insurance prices go through the roof. Same thing with options before earnings. The storm is the earnings report, and the options are the insurance. Now here's where it gets brutal. After earnings are announced, the uncertainty is gone. The numbers are out. Everybody knows what happened. And what does the market do? It drops implied volatility, hard. We're talking 30 to 60% drops, sometimes more. This is called the FOR crush. Or volatility crush. Same thing. And here's the part that messes up new traders. You can buy a call, the stock goes up, and you still lose money. Because the FOR crush eats so much value out of your option that the directional gain doesn't matter. Your option was expensive before earnings because of all that uncertainty. After earnings, that uncertainty is gone, and the price of your option craters. This is the number one way new options traders lose money on earnings plays. They don't understand that they're paying for uncertainty, and when the uncertainty disappears, so does their money. So how do you know if your option is overpriced? You look at the expected move. The options market prices in an expected move before earnings. It's basically the market telling you, hey, we think this stock is going to move X% after the report. Real example. Robinhood, ticker HOOD, went into earnings with 116% implied volatility. That FOR was pricing in a 9.6% move. So the options market was saying, we expect HOOD to move about 9.6% after earnings. Here's the key. If the actual move is less than expected, option sellers win. If the actual move is more than expected, option buyers win. It's that simple. You're betting against the expected move, not just betting on direction. Alright, so what strategies do people use around earnings? Let me walk through a few. The long straddle. You buy an at-the-money call and an at-the-money put at the same strike. You don't care which direction the stock moves, you just need it to move big. Sounds great, right? But here's the problem. You're buying both a call and a put, both with inflated FOR. So you need a really big move just to break even after the crush. The long strangle is similar, but you buy out of the money calls and puts. It's cheaper, but you need an even bigger move. Like, the stock has to absolutely explode for this to work. Both of these are buying premium into FOR crush. It's like walking into the hurricane and buying 2 insurance policies. Expensive and probably not worth it. Now here's where it gets interesting. Selling premium. Iron condors, credit spreads. With these strategies, you're betting the move is smaller than expected. And the FOR crush works for you, not against you. When you sell premium before earnings, you collect that inflated premium. Then after earnings, FOR drops, and you can buy back your options cheaper. That's the play. The crush is your friend. Calendar spreads are another approach. You profit from the volatility crush itself. The idea is you sell the front week option with high FOR and buy a longer dated option with lower FOR. When the front option's FOR crushes after earnings, you profit from that differential. Okay, let me give you some rules. These are things I wish someone told me before I started trading options around earnings. Rule 1. Stick to risk-defined strategies. Always. If you're selling premium, use iron condors or credit spreads where your max loss is defined. Never sell naked options around earnings. One bad trade can wipe you out. Rule 2. Keep position size small. Earnings are a coin flip with extra steps. Don't bet the farm. I'm talking 1 to 2% of your account, max. Rule 3. Understand the expected move before you trade. If you don't know what the market is pricing in, you're flying blind. Look at the 4, calculate the expected move, and ask yourself, do I think the stock will move more or less than that? Rule 4. 4 crush is real and it will eat your options value. Don't buy naked calls or puts right before earnings expecting a big payoff. That's gambling, not trading. Look, options are powerful tools. I use them. But earnings season is a different animal. The volatility dynamics are working against you if you're buying premium, and they're working for you if you're selling it. Understand the game before you sit down at the table. Volatility going into Q2 2026 earnings season is relatively low overall, but individual stocks will absolutely surge. The principles don't change. For spikes before, crushes after, and the expected move is your benchmark. Educational content, not investment advice. Do your own research. Understand what you're trading. And I'll see you in the next one.